Other investors may be going risk off. If you're going impact on, you'll want to grab Impact Alpha's best deal of the year, 50% off an annual subscription. That's $200 off the regular price. Go to impactalpha.com/subscribe. I'm Brian Walsh, and from Impact Alpha, this is another episode of our Institutional Shift podcast series.
The money representing demand is going to outdrive the supply of carbon transition infrastructure projects, and the demand for forward positions on credits is going to drive the demand for projects as well.
That's Dave Chen, CEO of Equilibrium Capital. In this episode, Dave and David Bank look back on the predictions they laid out for 2020 and look ahead to 2021. Let's jump right into their conversation.
Hi, Dave.
How are you?
I'm great. It's so good to have you back. We've been doing these annual kind of look aheads for 3 or 4 years now, trying to lay out some of the themes that will come up in the next year. In this case, what's coming up in 2021. I thought we might start actually by just taking a quick look back at 2020, because predicting was kind of a, hazardous occupation for this year. So let's just take a quick dive through what we actually said. We actually put this out a little bit later in February of 2020, just before kind of the world changed. But here's one that you called out. You said the carbon footprint of air travel was going to turn road warriors into pariahs, and that investors and others were going to think twice about flying around the planet to talk about saving it. So what happened to air travel this year, Dave?
Well, it's better to be lucky than good. Sometimes you get to be both. Look, we spotted early last year that our leading investors were becoming much, much more concerned about their own carbon footprint, and much more concerned about us as investment managers on their behalf and what we were doing. And we started to see that pretty widespread. And the pandemic sort of solved that one, huh? But I think for me, the interesting thing will be there are so many folks that we have talked to who have found that much of travel might have been unnecessary. And there is travel that is necessary, and the human relationship development that's necessary. But so much of it might, in fact, be unnecessary. And I'll tell you, my prediction for 2021 is that from a social standpoint, in business, I think we're going to develop a new vocabulary in business, which is, I'll call it permission granting. And so we'll find artful ways of granting our business partners permission not to travel. And we'll find artful ways of saying it, like it'll be a little bit like being a smoker. Excuse me, can I smoke in your house? And the answer will be no, or yeah, sure. And I think we're going to develop the same kind of etiquette of, hey, listen, will you hold it against me if I don't travel to London to stand in front of you to pitch the deal? And the other side will develop the vocabulary. No, we won't hold it against you. In fact, we might even reward you. So I think we'll learn how to say that politely and really mean it.
Indeed. And I think in some sense, the default will maybe fall on the other side, is like, don't come unless you really have to.
Right.
Yeah.
Right.
The other one we flagged, which also has a pandemic relevance in a more serious way, is that we talked about the S in ESG, the social aspect, and in effect income inequality, and I don't think we called it out, but effectively also racial inequality and racial justice. And we flagged that as share the wealth, and that social issues were going to come to the fore in 2020, which indeed they have, for better or worse, I guess.
Yeah, I mean, I think that McKinsey calls COVID the great accelerator, and that it accelerated the presence of certain trends that were already in society and already in the marketplace. And I think this one is perhaps the most poignant of all, and not just the aspect of making race very visible and putting that right in the front, but this whole issue of, we've known for years now that a huge hunk of America doesn't have more than a few $100s saved. And I think we saw that this year. And again, COVID put it in our face in a way that we couldn't really avoid it. And frankly, given where we are as a country today and the fact that we now continue to have unemployment at staggering rates, we are clearly not done yet. And between the homeless and those that are working shift and gig jobs, those that are working in hospitality, those that are working in lower rung jobs that now put them in very, well, it's not even precarious, just out and out, um, life threatening kinds of situations. These are now very, they're in our face and we can't avoid them.
Indeed, and again, as you said, the great acceleration. So there's both, I think, greater awareness of the role and value of essential workers, but there's also, big pushes, for example, towards automation and other things, in part to, make workplaces not have to have as many human beings who can get sick. So there's lots of cross currents there. I don't know that it's completely sorted out in terms of which way things are going to go. Another trend you called out last year, which I think did play out as well, is sort of consolidation in this sustainable investing, sustainable finance, impact investing world, mergers and acquisitions. How's that playing out?
Well, I think that's actually one of my forecasts for this year is some of the areas that I think are going to be very promising for mergers and acquisitions. But in just the last couple of months, we've had two very very important transactions take place. One was Morgan Stanley's acquisition of Eaton Vance, and really the crown jewels that are in there were Parametric, and to a smaller degree Calvert in that platform.
Which Eaton Vance had earlier acquired. Yeah,
Yep.
yeah.
Yep. But the parametric one was, I think, the really important one. That was in the area of customizable index. And much of the recent growth was in the serving the demand for ESG oriented customizable indexes. So now you've got Morgan Stanley clearly in a very important position with that acquisition of, I dare say, dominating that modality of investing. I think that just last week we saw BlackRock acquire Aperio for $1 billion, and very similar thing: the customizable sustainability, ESG, climate, ESG values driven indexing. And so you've had two of the leading players now taken off the market and put onto very large consolidated platforms.
And the as you said, the lure of that is this apparently very strong demand from investors for ESG type products. I think in terms of the capital flows to those funds, it's the non ESG funds are maybe losing capital, and the ESG funds are raking it in. And these folks now can offer those, as you say, kinds of products more cheaply, easily, quickly.
Yeah, and both of them had distinctive differentiation and capabilities that made them unique. But I think they were both recipients of the quote unquote tidal wave of demand that was taking place and had the wherewithal to be able to serve them in unique ways.
Another one we flagged, which we at Impact Alpha tried to pay attention to all year long, was this what we think we call the corporate strategy shift, and it was in a sense the operationalization of sustainability inside corporate operations. We spent some time with Schneider Electric, which is generating a large share of its revenues from this shift to what they call distributed, digitized, decarbonized energy, and driving a sort of upgrade cycle there. And then one I know you liked was John Deere. We just noticed on their analyst call for their quarterly earnings that some of the analysts are raising their numbers on Deere because of this precision ag technology that you called out, where they're basically helping farmers adapt to climate change with new technology. That climate adaptation has become, in effect, John Deere's growth business.
Yeah, and I think John Deere in particular, I respect the fact that they saw I call it the business opportunity that or the economic advantage for their customers, the farmers, in things like soil carbon and in things like reduction of the use of herbicides and things like that, and yet we're able to, I think, very very practically talk about those without ever using the word climate change or without using buzzy terms like carbon sequestration, and really translate this into terms that the farmer could understand as part of their productivity and their basically making more money or having a better asset.
Well, and so what is what are the other examples of that? I mean, what are the other companies, but what are the other kind of categories where sort of the sustainability imperative is now becoming the value driver for that company, not just, not just cutting a little, using resource a little bit more efficiently or cutting waste a little bit, but actually driving the solution.
Hey, are you asking me now to launch into the 2021 trends and predictions?
Well, yeah, there's a kind of continuity between the 2020 and the 2021. So let's just roll into it. I know you've got some thoughts on where things are going to go with carbon and climate change.
So I think that one of the first and most important themes I'm going to focus on is the corporations again. And I think that there are four strategies that I think we're going to see in 2021. The first one I think that you're going to see is an old term that was at first used by Intel in the 90s, and that's the creosote bush. And you're going to see a bunch of companies that have succeeded beyond their wildest imaginations in a fossil fuel oriented era that lasted 100 years. And it's so egregiously profitable. And now they have to figure out a way that they're going to do something quote unquote new that survives in the shadow of something that is so powerful, so dominant in their company. The creosote bush was, as I said, Intel used this term because they desperately in the 90s wanted to expand the footprint of their company beyond the microprocessor. But everything that they tried to do, every market that they entered, every category that they entered, paled in comparison to the power, market share, and frankly, profitability of the microprocessor. So it basically, the strength that they had in microprocessor killed everything else. You're going to see this strategy being executed or challenged by the entire oil and gas industry. All right. And that is that given oil and gas, how do they build something from within their company that challenges the cash cow that has dominated their thinking, their paradigm, and their profitability and their market positioning for 100 years?
That's a classic innovator's dilemma, Clay Christensen sort of idea where you are sort of reluctant to cannibalize the existing cash cow for the new thing, which may not be as profitable.
Absolutely, and if you take BP did a great job in the early 2000s, saying, "Hey, we're going to be the green BP," and they bought several $billion worth of wind farms and other quote unquote renewable assets. It was big enough to show off, but then they quietly, by the time we got to the end of the 2010-ish period, they sold them off, changed in strategy. Well, BP is going to have to do it again this time, except it's going to come in 10, 20, 50 billion-dollar chunks that they have to now build in order to outrun the decline of oil and gas.
And on that, Dave, the innovator's dilemma question is interesting because it's, the oil and gas industry is not now so profitable. So you'd think it would be easier to let it go and move into the areas of the future. There was a moment a couple weeks ago when Next Era Energy, renewable energy company, surpassed Exxon in market value.
That's exactly right. And we have many, many examples of this. We have the entire automotive industry lagging Tesla. And there are fundamentally different ways of thinking about this. And Tesla doesn't think about the electric automobile, the EV, as simply take the drivetrain out and replace it with electric motors. They think about it as a very different platform. They think of it almost as a iPhone with four wheels that's geared for transportation in terms of where the value's added, how they think about the value proposition to the consumer. It's an entirely different way of thinking about it. Well, you're gonna have to watch the industries wrestling through with this. So I think this old strategy issue of whether you look at it from the Clayton Christensen or the creosote bush, this is what we're going to watch big companies do it. And I think this year we're going to watch major corporations dealing with this, and it'll be very visible and out in public.
Well, and it's a, as you say, it's a huge management challenge to manage that transition. There's obviously, several pathways through it. There's the dig in your heels, obviously, and try to milk as much, as you can out of the existing oil and gas, fossil fuel infrastructure. There's the jump quickly. There's all kinds of startup strategies, obviously, to try to be disruptive, as you said, and Tesla being the everybody's everybody's not fever dream at night. But how does it play out, and what are the things to watch for?
Well, I mean, I think that you hit it, and that is that when I have plenty of time, 10 years ago, to actually bet on startups, well, and let the passing of time create significance and bulk and sufficient revenue and sufficient market. Well, today, if I have to do that transition, what is it that I can buy that's, again, in $10 billion, $20 billion chunks? Because that's what I'm going to have to do to turn the company. I don't have 10 years to wait. All right. I think the second strategy in corporate that corporations going to be dealing with is, and this has as much to do with environmentalism as anything else, and that is this concept that I would call the original sin. It always was fascinating to me that people will protest things like mining, but yet they like their cars, and for that matter, they like their iPhones. And the challenge that we have to make room for is the fact that uh, the sin has been created, and whether the sin is the fact that we did mining, or whether we in fact burned the rainforest and created palm oil plantations, or whether we had done that a century ago and now have rubber plantations. The original sin was the desecration of the environment, right? To be used for these human productivity requiring natural resources. The issue is, what do you do now? And odds are that no matter where you are, there are going to be severe restraints being put on the new burning, or the new mining, or the new uses of lands for those purposes. But what happens to the lands that in fact are already being deployed in those, and how will we make them, quote unquote, more sustainable? And I think that this will now become a bona fide conversation. It has for the last number of years, I think, had a third rail kind of aspect to it, which is all palm oil plantations are bad. All, this, that, and the other thing are bad. And this year, I think, because the corporations are now stepping up and realizing that they're going to have to build a sustainable future for themselves in these categories, I think we're going to have the first meaningful conversations this year about, well, what is it that we can actually do to take these original sins and now focus on making them sustainable assets.
And that means sustainable cement plants, sustainable petrochemicals, sustainable mining, as you say, sustainable, uh, obviously sustainable transportation.
Well, you're not getting rid of your tires off your car. You're not getting rid of, I mean, the truth of it is that palm oil, in actuality, is one of the most efficient forms of renewable oils. It's just, how those plantations came about. So how do we live with something that in fact is actually very efficient and very usable, and in fact is much more than just cooking up a French fry. It is actually a precursor for many other chemical uses that, in some ways, replace petrochemical use, and it's also a leading source of biodiesel. So how do we now rationalize the fact that the original sin has been created, and we make better, more productive, more sustainable use of some of these resources?
Well, and the general way is to say, as they say, internalize the externalities, and both positive and negative. The negative ones are well known, as you said, the despoilization and the deforestation and whatnot. The positive ones um, could be, as you say, like, learning how to do all this better. People can get paid for that, whether they get paid for more water in the watershed, or cleaner air in the cities, or other kinds of positive benefits that come from new approaches.
Yeah, I think the third corporate strategy that I think we're going to start seeing in 21 is the understanding that Moore's law is hitting many of the avenues or many of the areas of sustainability. And I'm using that a little bit as an exaggeration.
Because there's no actual law, I hate to tell you, but yes.
No, I mean, the application of Moore's law was such an extreme situation with regard to the microprocessor and the power of the microprocessor, and its ability to double that every few years.
But it become it be the my point was it wasn't a law, it became a self-fulfilling expectation and thus a design criteria for all chip designers that they had to hit that, and once they're all designing for it and have to hit it, then they all hit it, and then it becomes self-fulfilling over time, and as you say, it's happened in solar panels, it's happened in batteries, it's happened in all sorts of other technologies for the
For
same
the
reason.
same reason, we're watching it happening in agriculture. Watching it happen in the automotive industry. I oftentimes say what do I, as a consumer, expect in my car 5 years from now? What, a better leather package, incrementally better mileage in a very, very small way. But what do I expect in my relationship to the Tesla in 5 years? I expect that for the same $50,000 or $40,000 I spend, I got a whole lot more car. I either got self driving, I got, you know, all forms of data driven convenience. I got better performance on the battery. Maybe not Moore's law, but in the, you know, double digit percentage increase. I got better efficiency on the motor, et cetera, et cetera. So for the same $50,000 or $40,000, I expected double the car. All right, and you really didn't expect that from your Chevy or your Mercedes. That 5 years from now, for the same 60, 70, $80,000, I got double the car. And I think that's an expectation management that we're seeing the full force of technology being applied in the sustainability area across multiple industrial sectors.
Well, I know you've been very active in agriculture and in this sort of technological revolution in agriculture, with controlled environment, ag, high tech greenhouses. But the yields are just like that, right? I mean, you're getting kind of double digit percentage increases in yields, and applying technology to food, good old fashioned food, right?
Yeah, I think we're forecasting that we could see as much as 10% per annum productivity increases in the greenhouse. And in part because so much technology and overlapping technology now is being thrown at these problems. The the fourth strategy, in a way, John Deere exemplifies this, and I'll call that the great burp forward, and that is that for the last 4 years, out of fear that you, as a corporate citizen, use the word climate change too publicly, in especially in the targeted industries, you might get a Twitter slam from the administration. And I think that the reality is that much of this stuff has been going on underneath the surface now for the last 4 years inside of corporations. And I think that what we're going to see in this next year is that much of the stuff that actually has been hidden or not talked about very overtly is going to come out like one big, massive burp. And and, and frankly, I'm actually very optimistic. I don't think it'll be greenwashing. Again, as I said, the stuff that John Deere is doing, they have not, and they've been very careful not to associate the word climate change, climate adaptation, modifying, can't move dirt. If the climate's changing in your region, you can't just up and lift your farm and go somewhere else. So I think that they've been very artful and very careful, but I think they're going to watch them take take not just credit for it, but overtly now out in the open, really start to talk about these kinds of things. And again, always in the context of how they add value and make their farmers more competitive. I think you're going to see that in multiple industries.
Well, just to the point, we couldn't have necessarily predicted or a year ago what the results of the election would be. Now we don't have to predict. There will be a new administration, uh, we think, and the signals from that new administration, as you say, are all around climate action, around ESG and sustainability in finance. I mean, a lot of the things that have, as you say, have had to kind of percolate under the radar for the last 4 years now become the policies and the signals and the incentives in the new administration.
Dave, if you don't mind, I'm going to rattle through the rest of these 2021 forecasts. I think the next big one is that next year will be the year of the I'll call it the carbon race, and carbon credits are going to come. We had a brief moment in this country in the mid 2000s where between the carbon exchanges and the voluntary markets, we had a big leap forward on the number of projects. But I think this year you're going to see in 2021 a land grab, so to speak, for carbon credits. You're going to see major companies buying inventory positions on forward positions of carbon. You're going to watch the carbon protocols, whether that's regenerative soil carbons or whether that's sequestration and the science behind sequestration in other formats.
Forest carbon, soil carbon, like you say, all kinds of ways to get credits. And you're saying the demand will go up both voluntarily and also under mandated regulatory regimes?
And you're seeing that de facto in some of the things that are taking place, for example, on the West Coast with the renewable fuels and things like that. So you're going to see it across a range of things. But the key thing that I'm highlighting is folks are going to start taking inventory positions. So forward inventory. So unlike if you build it, they will come. I think the reverse is going to happen in 2021. Companies are going to take forward contract positions and contract ahead of production for the buying and the securing of inventory.
Which creates an industry of creating those credits that can then have more visibility into the future and scale up bigger projects.
Dave, demand drives everything. All right. And 21 is going to be the year that demand will drive and will grossly outstrip supply. Grossly.
Pushing prices up and making the whole thing more economic as well.
You have some inventory positions that may be the entire year's worth of production or the entire next 5 years worth of production.
And just to be clear for the listeners, the buyers of these forward inventory positions are like who?
Companies. They're not speculators.
For their own operational needs. Yeah. And not just oil and gas carbon emitters, but all kinds of companies.
You could see oil and gas doing it.
Yeah. Yeah.
Because they have to now.
Yeah.
And the drag along to the opposite side of that is as there is demand, you're going to see the incredible growth of carbon transition infrastructure kinds of projects. And again, the incredibly high demand for those projects. And again, this time from the capital markets, because we're so grossly undersupplied and the demand is now going to outstrip the supply. So money will drive the money representing demand is going to outdrive the supply of carbon transition infrastructure projects, and the demand for forward positions on credits is going to drive the demand for projects as well. So both the capital side as well as hard inventory positions. The next one that I would see is this is the year where standards start becoming regulatory law, and we're going to see the consolidation of standards. We already saw it a few weeks ago with SASB and the merger and the creation of both a U.S. now and a international set of standard platforms starting to take place. But I think this is the tip of the iceberg. And then
and just on that, the Europeans are very keen on that and driving it forward in all sorts of ways.
And that was the merger.
No, yeah.
And the other part of that is that, and we're seeing this with my Kellogg hat on, in terms of the amount of academic peer review, data-driven research, and the quality of the research that's emerging. Look, the Moskowitz Prize has been around for over 20 years, but the level of research that's taking place and the level of conclusions that's taking place, these are now big pieces of work that are starting to prove the efficacy of many of the things that we thought or believed was going to be true out of the E, the S, and the G in terms of outperformance, in terms of impact on S, impact on E, impact on the competitiveness of companies. And so standards are going to start to take form, not as voluntary or as advocacy, but increasingly as regulation. And the proof that these things actually make a difference is starting to appear in academic research. And I think between these two, the level of dialogue that's going to take place in 21 of new frameworks, new risk theories, we're going to see that. In other words, CIO level conversations, we're going to see that one taking off in 21.
And again, you mentioned risk. It's similar in many ways to the way that the sort of risk analysis developed several decades ago, and became a part of any kind of investment decision making, and got quantified and traded and whatnot. Now you've got impact, sustainability, all these kinds of metrics becoming part of just everybody's financial analysis.
And I think that risk in the sustainability world, and when I use that framing, I'm dragging everything along with that. Climate change, the ESG, all of this. When you put that together, risk will transition from something that we talk about as a concept into a concept that increasingly will be pricing, and that will result in pricing. The last thing that will happen in 21 is that this move in the major financial services platforms. All right, the game's over in major financial services platforms, and that is sustainability is no longer the small group off to the side. It is now becoming integrated across the platform because the likes of Aperio and Parametric have been taken off the market. Next year, 2021, all the attention in M&A is going to be paid to the alternatives. And that will go all the way from deep integration into private equity. It'll be taking credit for the work that folks have done in real estate. And then it will go all the way to hedge funds. You're going to watch activist hedge funds execute along the lines of what I talked about in the first 10 minutes of our conversation: the creosote bush, the original sin, Moore's law, the great burp forward. You're going to watch the alt and the private markets playing out those strategies, taking advantage of those, or playing to the bottom of the rung performers that aren't doing those strategies, and either taking them over at a discount or short selling them. But the alts are going to be, I think, where it's at in 2021. And in part, that's an easy one because the cool liquids in terms of public and the fixed income and the green bonds, that's sort of done. That's now moved into execution phase.
And just let you wrap it up with taking it back to this institutional shift. You mentioned the hedge funds and some of those guys, but we've always talked about the big pools of capital, the super tankers of global capital, the pension funds, the sovereign wealth funds, the insurance funds. You've been tracking and living, frankly, the shift as they kind of wake up to some of these sustainability trends. Where does that institutional shift stand now as we head into 2020?
It's something has changed when of course, we haven't been able to get together in conferences live in for now 9 or 10 months. But it's a very odd situation when you go to one of the virtual conferences, and some of these conferences now have adopted these avatar settings. And when you walk into a virtual bar table conversation at a virtual conference, and you find the chief risk officer or the CIO of several of the sovereign wealth funds and these large pools of capital overtly talking about the role of S and social equality and social access and social mobility, not as a after dinner conversation, but as in conjunction with their obligation and duty and opportunity set within the context of their portfolios. And we started to see that this year. This was not about the after dinner conversation. This was now absolutely part of their portfolio conversation. And so who knows where that leads, but that was a pleasantly shocking change that took place this year. And we saw several instances of that. And I think that's a signal of how we're starting to think about maybe the closed loop of pensions and sovereign wealth funds, which is as our respective societies go, so too will our ability to make good on the pensions that we're challenged to manage on behalf of those populations.
Well, Dave, I applaud your willingness to make some predictions going into 2021 in an environment that many people think is, highly volatile and unpredictable. But you've always been a master of the long-term trends here, and I think you did pretty well going into 2020, all things considered. And we're going to check back with you, obviously, again next year. We'll check back with you before then as well, as we continue to track this institutional shift. Thanks for being with us.
It's always good to back test your portfolio management.
Thanks, Dave.
Thank you.
That's going to do it for this episode of Impact Alpha's Institutional Shift. You can read more about Dave Chen and Equilibrium Capital at impactalpha.com. Subscribers receive full access to Impact Alpha content, including deal flow, job postings, and members-only Agents of Impact calls. Don't forget to grab Impact Alpha's best deal of the year, 50% off an annual subscription. That's $200 off the regular price. Go to impactalpha.com/subscribe. Thanks to Dave Chen and our producer Isaac Silk. I'm Brian Walsh, head of Impact for the fintech company Liquinet. Until next time, take care.